Hi, everyone. It's Jason Maida with American Pacific Mortgage. So, today we're going to continue on with our building blocks of homeownership series, and we're going to dive into credit. Credit's probably one of the biggest challenges for most of our buyers as they're preparing to make their home purchase. So, I want to give you a few tips and resources to think about around credit. First thing we're going to talk about today is credit utilization. Credit utilization makes up about a third of the entire credit score weighting system. So it's super duper important. And so as we think about utilization, it has to do with revolving credit. So if we were to have, let's say, $10,000 worth of credit limits and we have 5,000 in outstanding credit balances on those accounts, that means I'm at 50% utilization. So our rule of thumb in managing utilization is to at least at worst case scenario, get below 50% utilization. So that means those balances need to be below $5,000. Now, if I'm really good there, I want to optimize those accounts by getting below 10% utilization. That means the aggregate of my accounts need to be at least below $1,000. So that's going to give you the best shot at optimizing that credit score as you prepare for home purchasing. Now, one tip around utilization I think it'd be super useful for everyone is that when we look at our revolving accounts, there's two really key dates to a billing statement. So there's the billing cycle date, but there's also the due date. So the billing cycle date is when the credit card issuer closes down that billing cycle and then sends out the information to the credit agencies, things like your payment history, what your utilization looks like, if you've had a late charge or over limit. So all that stuff gets passed out to the credit bureaus. So TransUnion, Equifax, and Experian. So that happens at the end of the billing cycle date. So my tip for our audience here is if you can, try to pay down those balances before the end of the billing cycle date, because what's going to happen is that you're going to have kind of a better impression when it comes to your balances on the credit bureaus, because now those balances have been paid down before it has been reported to the credit agencies. So that's the first thing. So that's utilization of credit. Second thing I want to talk to you about is inquiries, more so around hard inquiries. So now there are some rules in place for hard inquiries that say that if I am applying for like a mortgage or maybe of a car loan, I have 30 days to apply with as many lenders as I want to in a 30-day window of time. And it's the equivalent of one credit inquiry hit to my score. So that's something you want to kind of keep in mind. Now, all that being said, one of the things with our process that's a little bit different than most lenders is that we always start with a soft credit check. And the reason why we do that is because we primarily work with first-time buyers. So some of our first-time buyers may be planning for purchases in 2025 or beyond. So we don't want to necessarily impact their credit score by looking at their eligibility today for a future home purchase. So, that's the difference between a soft inquiry and, of course, a hard inquiry. Now, as many of our audience members know, there are three different reporting agencies for the credit bureaus, right? So there's Equifax, Experian, and then there's TransUnion. Now, those agencies all report three different scores, and there's different characteristics that are inside of their models that make up that credit score. So whether I'm a 790 with TransUnion or a 780 with Equifax, there's different characteristics inside their models that are basically changing what that score might look like. Now, as we know, there are three credit agencies giving us three different scores. In lending, we look at the middle score of all three bureaus. For example, if my top score is a 790, my middle score is a 780, and then my lowest score is 760. From a lending perspective, we're going to use 780 for our scoring and determining eligibility for our buyers. Now, if I have a partner that's also going to apply with me and my partner's scores are 720, 700, and 680, 700 is the middle score for my partner, whereas mine is much higher, right? So we always look at the lowest middle score between both borrowers. So in this case, my partner's score of the 700 would be what was used for eligibility. And that's really important because that can not only drive our interest rate offering, to a certain extent, the product offering, but also mortgage insurance. So really important to really understand that as we prepare for home ownership. Now, if you're looking to kind of prepare yourself for home ownership and want to get connected with us for a consultation, we love to be able to help serve you in that need as well. And we also teach free home buyer educations, usually once a week, that you can tune into at any time. To learn a little bit more about some of those resources, you can check us out at mortgageeducate.com.